Hi everyone, my name is David Cosmeter. I am a creator of TimingResearch.com, and this is our show for June 22nd, 2015. Today we will be talking about the 91st weekly report from Timing Research, and if you haven't had a chance to take a look at that yet, just go to TimingResearch.com/reports. And I have Dave Landry hosting for me again, so I'm going to turn it over to him.
Okay, thank you, David Cosmeter, and thank you to Timing Research for having me back once again. Looks like we've got a group of veterans here today. Ed, let's go to you first. Ed Carlson of SeattleTechnicalAdvisors.com. To those of us who don't know you, tell us a little bit about your trading and SeattleTechnicalAdvisors.com. Take it away, Ed.
Hi, David. Those of us who don't know me, I think everybody knows me, don't they? I run a website called SeattleTechnicalAdvisors.com. I've written 3 books on the work of master technician George Lindsay, and it's that's kind of the niche. That is the niche for the website, using the methods of George Lindsay to help time the market.
Cool. Let's go to you next, Roy. Roy Swanson of SteadyTrader.com. Tell us a little bit about yourself, and tell us a little bit about your trading and SteadyTrader.com.
Hi there. Yeah, my name is Roy Swanson. I run a website called SteadyTrader.com. We basically have an algorithm that we call the green light trading algorithm. It's essentially price trading for short-term trends, 1 to 5 day trends, and really pretty simple. I've been trading for 20 years, and really try to stick with getting into the middle of a trend. What I think of as very safe trading.
Yeah, that sounds good.
Not trying to squeeze every penny out of it.
Yeah, and that's hard for a lot of people. Being right versus making money is a very difficult thing. Jim, let's go to you next. Jim Kenney of OptionProfessor.com. Tell us a little bit about your trading, and tell us a little bit about OptionProfessor.com.
Okay.
And welcome back to the show.
Yeah, I'm sorry for just being a minute or two late. Okay, great to be here again. And again, I provide the content for the OptionProfessor.com, and the objective of OptionProfessor.com is to explain the uses and risks of a whole bunch of different option strategies and options of a general nature. Strategies include buying limited risk options for up or down moves, combination strategies like straddles and strangles, writing strategies like naked options and credit spreads, using these for a variety of different markets. So there's a lot of material, a lot of information there, and I've been doing it for longer than I'd want to admit, but now we do them on the internet. I used to have to go to all the hotels, the Hyatts and the Marriotts and all the rest of them, and the money shows, but now we're on the internet, which makes my life a bit easier. But
cool, yeah. I quit counting. I stopped counting after 20 years. A lot of moving parts with those options, so good work with education over there. Lots of things to get educated on. I'm Dave Landry of DaveLandry.com. Like Jim and everyone else here, I've been trading for a long, long time. I believe that you can only predict the short term when it comes to markets, but you can stick with markets longer term as long as the position moves in your favor. But obviously, a great analogy right now. I don't know if you can hear thunder outside. I'm looking out the beach and cloudy and thundering, and I'm pretty sure it's going to rain really soon. But I don't know if it's going to be raining this time next week or next year. So predicting the markets is sort of akin to predicting the weather. If it's cloudy and thundering, you know it's going to rain soon. But I believe, again, you can only predict the short term, but you can stay with positions longer term. So it's very important to take a partial profits just in case the trend doesn't materialize. And the way that I stay with that trend longer term is I gradually widen out the stop. So kind of start off as a swing trader and then gradually position into a position trader for part of the position. I have a 21-page report that outlines all of that. If you check my website, there's a free reports button on there. You can click on that. And I do a daily, almost daily newsletter, I should say, and a daily trading service, and that's also on the website. Okay, let's go to you first, Ed, or back to you, I should say. Based on any technical fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower this week? And that's Friday's close of June 26th.
This is a little tenuous, but I think we have a good chance of seeing a top today, and then a decline for. Well, actually, I'm not looking for any kind of respectable low until somewhere between July 6th and 8th. So to answer the question, I think the market will turn back down after today.
Okay, and give us a confidence rating of 0 to 10. Keep in mind that 0 is 50-50, and 10 means 100%. So based on that recommendation, or not recommendation,
0 is
prediction.
50.
Yeah, it's a little confusing. 0 means that it could go either way, and then 10 means you're 100% confident.
Oh, well, I'm glad you explained that. That's different. I'll give it a 3.
Hey, I'm just the messenger. I didn't write the question.
All right.
So, all right, cool. Roy, let's go to you next. Roy, based on any technical or fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower by the end of this week? And that's Friday, June 26th.
Yeah, like you, Dave, I've got my short-term weather forecasting studio here, and never go out beyond 5 days. I'm looking at the market to continue to rise this week, though. I give it about a 4 to 5, but I do think that this will be this week will continue the uptrend.
Okay. So would it be okay to put 4.5 for you?
Give me a 4.5.
4.5. There you go. All right, Jim. Let's go to you next. Based on any technical indicator or fundamental indicators you want to use, higher or lower by the end of this week, and that's Friday's close on the 26th.
Well, you can get pretty paranoid when you keep looking at that Russell index to get negative on this market at all, because that Russell index just refuses to go down.
Amen.
And that has been one of the better Dave indicators that I've heard in the last few months, because although sometimes things look negative, transportation looks negative and other stuff looks negative, some stocks are rolling over that are kind of big name stocks. Yes, this Russell is certainly not rolling over at all. It made an all-time high here today. So I would say that neutral to higher would be the way to go for this week, and maybe they'll use the Greek resolution of some type as a catalyst to keep the thing going. But as far as confidence, probably somewhere around a 2.
A 2, okay. So we're going to put you at higher because neutral's not an answer.
Yeah, right. Well, like I say, it would have to be to higher, yeah.
Okay, cool. I agree with you as far as the Russell 2000. Big fan of the Russell, or the Rusty as I call it. One thing that I've noticed recently, and I guess I could wait until we get to the next question for this, but one thing I've noticed recently is that, as you pointed out, there is some problems in some of these bigger cap issues, but the smaller cap issues seem to be carrying the torch or taking the torch, whatever the torch is being passed, I guess is what I'm trying to say. And the other thing is that the S&P 500 has been above its 200-day moving average. The lows have been above the 200-day moving average, and I call that daylight. And if you look on my homepage today, I've got a chart of that explaining that, and I did an article recently on that for Proactive Trader magazine. And it's been above that moving average for a couple of years now, and it dipped below it just for a few days here and there. Almost just a handful of days, and if what I've learned is just to err on the side of the trend, and you'll be right more often than not, and you'll certainly be right. You'll be right every time, but you'll be right over time. So I'm going to go ahead and give myself I'm going to go ahead and say it's headed higher. I'm going to give myself a confidence of a 7 on that, and I'm just going to stick with the longer term trend for now. Okay, next question. We're going to talk a little bit about what we're watching out for. Let me just get to it here. Ed, it's going to go to you first.
All righty.
And I guess every time we say the word grease, we have to take a shot. So let me go get some tequila.
Ouzo, whatever it is.
Oh, Ouzo, very good. We should. Maybe next show we'll do that. That sounds like fun.
Maybe David's got a bottle on his desk behind him there.
Yeah, I'm not allowed to make fun of his.
He's got quite a collection.
I guess he has a bad market day. Just turns it around and.
Yeah.
I had some Sambuca until recently. That's as close as I had.
Yeah, Sambuca is good too. I like Sambuca. That's close enough. I had some Ouzo once from Greece. Yeah. What do you call it? What's it called, Ed? Ouzo. Somebody brought me some from Greece, and it seems to be a little bit more powerful than the stuff that you get here. So there's some rumors.
It's about 95% alcohol, Dave. It is.
Wow. All right, Ed. I guess before we digress too far, when developing events, they can be technical or fundamental. Will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets? And I guess we get ready to take a shot for Greece.
Yeah, no, I'm not much of a fundamental guy, except maybe as a contrarian. I mean, it would fit into my scenario for a high today if we were to use the old bromide. Here we go to the beach.
Yeah. Y'all have fun.
Of buy the rumor, sell the facts, sell the news.
Yeah.
And so with all the rumors swirling that something's happening concerning Greece, that would be driving the market up because the consensus seems to be that they'll fix things because they couldn't dare not to.
Yeah.
Although the confidence level on a scale of 0 to 10, with 0 being 50-50, my understanding is no one's real confident. Anyway, so it's almost like you can't be left out of this rally.
Yeah.
Because everybody just knows it's going to happen. But then once it's over, well, then we got to get back to what we were doing before. And the market was going down before. Now I'll be totally honest here. This new high in the Russell, this does have me flummoxed. It looks pretty good, and if the market's going down, the Russell should be leading us down, and so that does have me bothered a bit. But for now, I'm keeping my horns in, and I think we're going to see some new lows.
Okay.
Take a shot.
Okay, Roy, let's go to you next. Yeah, we're going to take a shot. Based on any developing events, they can be technical or fundamental, will you be watching? Let me start over. What developing events, technical, fundamental, will you be watching out for this week that might have a positive or negative impact on the market?
I don't know what you just said, Dave, but here's what I'm watching. First, I look at my own algorithm, and I'll tell you that prior to the last 10 days or so, it's been the lowest in over a year. So it was really looking very, very weak. But starting about last Thursday, it started picking up each day, Thursday, Friday, and then I read it on Sunday. So that's why I'm feeling good. That's what I base my prediction on. Secondly, yes, Greece, and it's sort of, as Ed just said, it's the negative. I mean, just like the market keeps going up because there's nowhere else to put your money globally, they're not going to let Greece fail, and the rumors are starting to get all happy. And so, I think that was kind of a phony crisis, but so, I think as long as that holds, we're fine. The only wild card I see, but I just heard this morning is being pushed back, and that is the Supreme Court decision on Obamacare that could create quite a fiscal dislocation if they knock 5 to 10 million people out of health insurance. So, but they just pushed that off to next week. So I think this week is pretty solid. I think the trend will just keep up. And finally, getting back to real old-time basics. The big block traders, they like to pump the market up before the quarter. Now, this often happens in the third week. And, if you look back into December or September or, June last year, you see this happens most of the time. So I think this is the week that they pump it up. And, next week or the early July, different story. But, like I say, the big block guys, it's in their interest to pump it up.
Okay. Yeah, sorry, but there's a little bit going on over here. I was supposed to. Everybody knew for a week I had a show today, but they all decided. Everyone starts moving as soon as I begin talking. All right, Jim, let's go to you. What developing events, technical or fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Well, the European markets look like they've already put their bets down that the Greek thing's going to get resolved because the DAX was up 3.81% today, and the CAC about the same, and the FTSE was up 1.72. So Europe is up pretty darn strong here today. Yeah. Obviously, but again, the Greek thing is really a situation where most likely they're going to obviously provide them with something and get them off the front page of the economic news for a while, which they don't belong on in the first place.
I mean, is that going to take the whole world down? I mean, it's
like Rhode Island.
You get your atlas out. It doesn't look that big, Yeah.
It looks like Rhode Island to me compared to.
Yeah.
Really, amen to that. But the media love a crisis. Look,
Well, yeah.
Yeah.
Flood, famine, and war, right? You know.
But I don't think Europe wants that on the front page forever either. Anyway, there's cross currents going on. There's no question about that. You know, the Russell and the Nasdaq have made all-time highs again today. Dow and the S&P haven't. The transportation average, the 50-day average, has crossed over the 200. That's not good. Johnson & Johnson, Procter & Gamble, Walmart, Whole Foods, Google, Intel, they all have crossed over. Qualcomm, UPS, Southwest Air, Union Pacific Railroad. You get the 50-day average underneath the 200-day average. I don't think that's a positive. You know, that's obviously the cross current that is there, and the volume continues to be thin versus how many shares are outstanding. So if anything were to light a match for selling to come in, you know, obviously there's not enough people who are going to buy these all-time highs to keep the thing up. So I would be concerned if we broke 2070 on the S&P, if we broke 2050, which Dave has been said is the 200-day average been pretty good net. Catching the market on drops. So, you know, if you were going to be concerned about a drop, 2070, 2050 would confirm those fears. Otherwise, sideways to higher seems to be the most likely event going into the holiday, which, you know, we know is next week. And so, but, you know, if you start taking out the numbers I just mentioned, maybe some of these things that are telling me, you know, that, and even the oil shares, you know, they still have an inverted, 50, 200-day, but they're flattening out a little bit. Yeah, like Halliburton, Conoco, and Suncor, and that kind of stuff. But anyway, you know, like I say, I'm always worried about a drop because we're on the all-time high, and I see there's almost 6 billion shares of Apple outstanding, and I can see it trades 50 million a day. And my basic math skill tells me if a lot of people want to get out of a stock and it only trades X amount of million a day, and there's X amount of billion outstanding, that's not a fair fight. So, you know, that's always in the back of my mind because at some point, and you guys obviously are very short term in highlights, but, you know, at some point, you know, you have to keep an eye on that because the imbalance between shares outstanding and the volume per day, in my view, is a very, very worrisome on a little bit of a longer term basis.
Yeah. You know, Apple's down the Dow, and it seems to be having an impact on it, at least as far as making it go sideways now, because I guess everybody's fighting it out. It's becoming more and more efficient stock and less of a momentum-looking type of stock. I do, obviously, as everyone says, I do like the fact that the Russell is making the new highs. As a guy who likes to trade inefficient, smaller cap stocks, just the opposite of something like Apple, I'm excited as long as this continues to happen. And you're always going to have to question how long will it sustain itself, obviously. And so that's always a concern. And there are a few things out there that have me concerned too, such as I'm not really worried about Greece. And I think as Ed kind of hinted to, it's almost like the bomb already exploded. It's too late, you know, to worry about that. And I think Jim pointed out and Roy both about the media loves a crisis, and they'll move on to something else and really soon. And maybe Ebola will come back or something. Who knows? But there'll be another crisis as usual. These small cap stocks are doing pretty good though, and it's kind of interesting. I don't know if we're entering a speculative phase where real companies aren't very interesting, and everybody's interested in the biotechs and the IPOs and all these other stocks. But I really don't care as long as they're going up. Somebody once said that if I found out that intravenous drug use was going up, I'd be buying needles, and I don't think I'm that bad. But drug use is not going up, is it? So.
Say, Dave.
So yeah, I'm gonna keep an eye on the S&P 500. I love the fact that the Russell's at new highs. I'd like to see the S&P break out to new highs, and obviously the Nasdaq to get the breakout decisively and stick. And I think that'll be important. But for now, I'm just gonna follow along. My nickname's Trend Following Moron. There are some cross currents obviously out there that the bonds dropping eventually is going to put some pressure on stocks. But so far, it looks like that shoe kind of dropped a little bit, and then stocks stabilized, and then the small caps went up to new highs. So far so good. I'm not going to try to outthink it, but yeah, there's always something to worry about for sure.
Hey, Dave.
Yeah, go ahead, Ed.
Before we get away from small caps, I would point out that the VIX on the small cap, the Russell 2000, is not confirming the new highs in the index. Now, this data I've got is as of last Friday. I don't know what's happening today, but you usually see a positive divergence or non-confirmation from the VIX on the rut right before a minor top. Well, any kind of top, minor or major. So that's something we ought to keep in mind.
Okay. And what do you measure? What's the symbol for that VIX?
I'm looking at a chart of it right now, and I don't have a symbol. Maybe I put it on my. Let me look at my monitor here.
Yeah, I always
I'll find
learn
it.
new.
I'll find it. Go ahead.
I did a lot of research years ago and actually published a few VIX systems, and they worked really well until volatility dried up, and so that's a. But like anything, it pays to pay attention, but it only works when it works, is what I found. But it's definitely when you get those positive correlations or negative correlations in place, it's very important to pay attention. So again, I always learn something from these shows, so I'll have to keep an eye on that Russell VIX. That's interesting.
It is. See, Russell. RVX.
RVX. Okay, I'll pull that up in 1 second. While we're on you, Ed, if we kind of flip this question around a little bit, from the question looks familiar from a few weeks ago. We flipped it around, and instead of a day with a professional trader, what if you only had an hour? So if you had to teach someone, and you only had an hour to teach them, what would you teach them, and how would you approach that? And if you want, I could read the. You have the report. I could read the exact question to you.
You know, wow. With only an hour, I'd probably tell him keep his stops tight and don't do anything until you have more than an hour to study this. But in the spirit of the question, maybe what we were just talking about would be a good start. Divergences, whether it's divergences in the VIX, more traditional divergences in relative strength index. These things come up all the time. I even use my own version of the Copic curve on a daily and weekly basis. That's been a big winner for me, finding divergences there. So there's my answer, divergences.
Divergences, okay. All right, Roy, you're up next. If you only had an hour to spend with someone to teach them trading, what would you teach them?
I would basically stress what I would call money management in the terms of equal weight trades and tight stops, because you're not going to the tracks. So, as just sort of a discipline to keep people honest to almost any strategy, that kind of thing would help.
Okay. And the actual question is, what do you think would be the most important thing to teach someone if you only had an hour to spend? So that's the same answer on that from both of you guys?
I suppose so.
Okay. All right, Jim, let's go to you next. Same question. If you only had 1 hour, what's the most important thing you would spend teaching someone on trading?
Well, one thing before I get into that, I think what those guys are saying is it's very important to manage your bankroll. And that's I think what they're saying. When you're out there taking chances, when you're taking risk, when you're doing trades, managing your bankroll, meaning quantifying your risk as best as you can, keeps you in the game a lot longer if you happen to hit a few bumps in the road. But anyway, getting back to what I would suggest, obviously in an hour, options is a much larger subject matter. You want to find transactions that might be appropriate to your circumstances, because these things are not right for everybody, that's for sure. But if I was going to spend an hour, the first thing I'd want you to get a good hold on is hedging, using these options to protect your equity against adverse moves while trying to participate in the way you think things will work out, having something in there option-wise to kind of offset the risk a bit. And then, of course, the second thing I would want to go over is the writing side of the option, and through different strategies that try to take advantage of time and price working for you, and try to zero in on that. But the subject matter, as we all know, is very extensive, and spending an hour on it would be woefully inadequate, of course.
Yeah, that would be a pretty intense hour.
Get your coffee, get your Starbucks out, and let's go, right?
I think I was a mild influence on this question a few weeks back, because we were talking about spending a day with a trader, and I had a kid come over, and he was at a stock picking contest, and he was supposed to come over and spend a few hours with me. It ended up being like 20 minutes, and I ended up telling him just buy stocks when they make new highs, and I gave him a free charting package to watch, and he went from like last in class to third in class, and I don't know how he finished the semester, but it seems like because when he saw the open portfolio, I said, this is GameStop, and he got all excited. He goes, can I buy it? I'm like, no, that's a short. I want it to go down, but we don't have time to get into that, so let's just focus on price. I would spend 20 minutes. I divided 20, 20, 20. And the money management, we'll get to that in 1 second, will be vitally important. I probably should spend 55 minutes on the money management and 5 minutes on technique. But I would show them with technical analysis, if a stock's going to go from 5 to 20, it's going to have to pass through 10 along the way, and that's if a stock's going to trend, it's going to have to make new highs. So I would give them some homework. I tell them to go home and pay attention to a new high list, get your list of about 100 or so, and that's what I watch personally. I look at all 2,000 or 3,000 stocks in my tradable universe each day, but I keep a list of about 100 that are at new highs, and it's kind of interesting how many of these stocks can make a new high, then go on to double or triple from there. I would teach them one simple pattern as long as we're in price, something really simple like persistent pullbacks where you have a market that just tends to go up day after day after day. You can draw a line through the bars. Mathematically, that's known as linear regression, but obviously we wouldn't have enough time to get into that. I just show them how to draw a trend line and then just trade something like simple pullbacks off of that. And I have a TKO pattern, which is a very simple pattern where you have a sharp sell-off and you look to buy above that high. And a lot of times the market will keep on imploding and you'll miss a losing trade. The next 20 minutes or the second 20 minutes would be on money and position management, something really simple. Keep it really, really simple when it comes to money and position management. Take partial profits is what I believe in. It's not my way or highway, but I'd show them how to take partial profits and then trail the stop higher. One thing I would disagree with, we never have controversy on the show, but I would disagree a little bit with you guys talking about tight stops. I think you need to have appropriate stops. Tight stops, most people will end up getting stopped out of a market at a loss. So with tight stops tend to create more losses than they create gains. But obviously, you do need to have a stop in place. But the stop has to be outside the normal volatility of the market. So as part of the money and position management, I would show them that you can't have a real tight stop. If the stock bounces around 10-15% a day, you can't have an 8% stop like a popular method says out there. I've actually gotten into a heated debate with someone when I was in a seminar because they raised their hand. They told me my stops were too loose, and they said that this popular method that they follow uses an 8% stop. Well, I'm not sure how you could position trade if a stock, again, is moving around 20% a day with an 8% stop. And for me, that's like saying that everyone should wear a medium-sized shirt, which my fat ass hasn't been in about 30 years, so 40 years. But in the remaining 20 minutes, obviously, it's the longest distance between success is between your ears here. I would talk a lot about trading psychology and how the market is made up of a bunch of participants, and yourself included, and your job is to read the psychology of the market through the technical analysis, see what they've done in the past, see what they're likely to do in the future. And one thing that a lot of people don't realize, and again, I don't want to spend the whole hour talking about my hour, but one thing that a lot of people don't realize that are new to trading is that people buy and sell stocks for a variety of reasons. And Ed, you brought up the quote, I think, last time. How's the quote go from Marion McClellan, Tom's mom? People buy and sell stocks for a variety of reasons.
Some people buy and sell stocks when they need money or have money. Others use methods that are more sophisticated.
Yeah, and that's what people forget about it. When Tom gave a speech a while back, and he said, you're forming a relationship not only with the company, you expected the company to do good things, which sometimes the company just flat out doesn't. And that's a whole other conversation. But you're also forming a relationship with anyone who has purchased a stock previous to you, and those people will screw you. And I've got a friend who was at the same meeting, Dick Fruth from Houston, and back when he first got started, a lot of people didn't trust the banks, which we might be ending up in that situation again now. But he said people would actually bring their shares into him. He started off as a broker, then he became a money manager running millions and millions of dollars. But before, in his humble beginnings as a broker, people would hand the shares, and most of the other brokers would just take the order and process it and send the person on their way. But Dick would sit him down, give him a cup of coffee. It's like, why are you selling? Well, I'm buying a house, I'm getting divorced, I'm getting married, or whatever the case may be. Or my father just died, and I've got a stock, and I'm going to cash it in. Very rarely did they have a problem with the fundamentals of the company or even the price of the company. So you got to be really careful to realize that there's a collective mindset of the market, and you have no control over that. So you have to make sure you got your trading psychology in order. And some simple things you could do is just money management. You guys all talked about stops. That's very important. If you've got a stop in place, it takes you out of a losing trade, and you don't end up in that hope it'll come back someday. If you understand your methodology, my methodology, when the market gets choppy, you don't make a lot of money. You have to learn to live with that. I saw in the report somebody said they're printing money selling spreads. Well, what they don't realize is they've captured a bit of an aberration in the market, and not that spreads won't work longer term, but when this market begins to break out in earnest, or if it begins to break out in earnest or break down, they're going to lose a lot of money, and psychologically that's going to have a pretty big impact on them. But if that's what you do, that's what you do. Just make sure you fully understand your methodology. So money management is very important. Psychology is vitally important, but if you get your money management down and you understand your methodology, then the psychology will begin to fall into place. It doesn't ever get easy, but it gets much easier once you understand the markets, your methodology, and that anything can happen. Okay, Ed, let's go to you. Any closing thoughts on anything we said today, or anything else you want to tell us about SeattleTechnicalAdvisors.com or your trading?
Well, yeah. I had mentioned early, I think it was the first question, I said I thought that perhaps that this run-up today might be one of those buy the rumor, sell the news kind of deals. As of right now, I think we've given back half of the rally from today. So it's starting to look that way. In addition, one of the reasons, of a small handful of reasons that I thought today might be a high, was simply because we usually see the market turn after option expiration. And since we had a rally into last week, I thought that was just another arrow in my quiver. So I'll stick with my forecast that we're going to see the high of the week today. As far as the website, yes, everyone's welcome to come by and take a look. It's SeattleTechnicalAdvisors.com. If you have any questions, you can reach me through the Contact Us page, and I'd love to hear from anyone that's got an interest or a question. Thanks, Dave.
Cool. I'm glad you brought up options. I have a question I want to ask Jim when we get to him. First up, let's go to you first, Roy. Any closing thoughts or anything else you want to tell us about SteadyTrader.com?
Yeah, I should say that I do have a free ebook at the site at SteadyTrader.com. It's called Read This First Before You Buy Stocks. And it's a quick read of the 80-page book about some of the fundamental viewpoints behind our philosophy, and encourage anybody listening to go to the site and read the book.
Cool.
I think anybody will learn something from it.
Well, I want to check it out too, so I'll do that as soon as the show's over with. Appreciate you put that out there for us. All right, Jim, let me throw a question out to you about options before we let you wrap things up for the show.
Sure.
We had the expiration last week, and I was trying to explain to someone just from empirical research, or just, I guess, by living through it, experience. It seemed like years ago, option expiration used to be a really crazy day, and in more recent times, it's more muted. And somebody explained to me years ago that a lot of the unwinding happens early on. Has that been your experience with the markets?
It seems like they start pushing it one way or the other about a week before options expiration. So if the market was way down and all the calls have gotten very skinny, then all those people who are still shorting calls, trying to get that little last part of the cigar before it goes to dust, they're selling it thinking they got some kind of a sure thing, and then bam, they run it up, and those things have big expansion, and then those guys have to buy back their calls, and then the guys who are selling them might be market makers, and they can make a nice hit on them. So sometimes I've noticed that it can make a contrary move to what has been happening about a week or so before the expiration, and I think that's just running the option, running up.
So you think that becomes like a gamma get you thing? They're trying to get the people with the gamma? Is that what's going on?
Yeah, I mean, they're trying to get people, first of all, to give up on that side of the market. And so all those people that are long the options are dumping. And if they're dumping, who's buying? The guy on the other side might be the market maker. So now everyone has dumped those sides of the market to these people. They're the buyer. All of a sudden, there's no more volume that way. And that's pretty similar to what the one guy was saying here today, is that we all had a big volume on the opening, right? Because everyone's excited about Greece, and Europe's going nuts, up 3-4% today. So let's buy. Who's selling?
Yeah.
Well, probably market makers. Okay, so all that volume's been done, and now when we go home in 2 hours, if there's no volume behind it, and it already has started, it can fall under its own weight. Because, again, the volume stinks here, and so if, in fact, you get a lot of volume one side or the other, the market makers on the other side, and they're not nice people, they're going to raise the offer as high as they can to get the volume done, and they're going to drop the bid as low as they can to get the volume done, and that's what they've been doing for years.
I like that. I'm going to add that to my list of things to tell people. And they're not nice people. I'm going to
Yeah,
quote you on that one. That's pretty good.
no, they
Yeah.
might be from Brooklyn even. I don't know.
Thanks for the, you gave me a little fodder here. So next time I try to explain the compression and volatility and why it occurs, I'll quote you on that. But that's good information about getting
it's
on the gamma.
it's a merchandising operation. You need a buyer and seller for every trade, so you can never forget that. So if everyone is doing one thing, you got to ask: is the other guy such a moron, and are all of us geniuses?
Well, he might be a trend following moron.
Well, I mean, like I say, I'm sure you can get a pop on a trend, but like you're saying, you take a little bit off the table as it's going,
Yeah.
and then you put a stop on the rest. So you're never overly confident. You never lose your humility, because when you lose your humility, your wallet is probably right behind it.
Yeah, and how many times I like you pointed out the fact as a buyer and a seller. How many times have you heard on TV that there were more buyers than sellers? It's like, no, that's not how it worked. It's
No.
what's the commercial with Beatrice? No, that's not how it works.
No.
So,
But the sellers may be a group of people who have to put up their own money, and they're not going to put up their own money to the sell side until they make the offer to an area where they believe after this volume dries up, it can fall under its own weight.
cool. Yeah. No, I hear you, man.
I always wanted to get all the time and sales on who was buying in 2009 when the S&P was at 667, and get an idea of why they were buying, and why some of the larger firms were creating liquidity at those ridiculously low prices as people were panicking out on a fire sale. You know what I mean?
Yeah, it's kind of interesting. I've been doing a lot of reading lately on psychology, and it seems like there's a lot of talk about people who, they had orders in place with the market for a 50% haircut market, and they just leave them in place for years. And I just find that hard to believe, because once you see that market start imploding, if you had an order in place from 5 years ago, you'd probably be pretty inclined to pull it. But it's kind of interesting. Everybody's a genius in hindsight, I suppose. So, but
well, I'd like to just give a couple of final thoughts, if I could, real quick.
Please.
Again, two things. Well, actually, there's a couple of things that I'm kind of looking at. One is China. China's been getting pretty volatile. Up and down 6% and 7%. I mean, that's pretty good volatility on a one-day basis. And I noticed that China hit a 6,000 high before the crash, went down to 2,000, and now it's gone back to about 5,000 here in the last month or so. And that 5,000 area is where it really accelerated from back in 2009. So it could be resistance, and so far it has been resistance. So it'll be interesting to see if this thing can give you a 5,000 print. And if in the next few months it cannot give you a 5,000 print, there could be a turn in that area. And a proxy for China, a negative China, has actually been doing pretty good lately. Second thing is, we know yields have been rising, but I think that 2.6 area on the 10-year would be an area. If it started to get above 2.6, then I think the reality of higher rates might really be coming into play. And anything under 121 on the 10-year note future would also be kind of maybe deteriorating past the point of no return at that point. So those two things. And then finally, on the option side, the VIX, VIX, 15 to 16 area. If we were to get above that, and correspondingly on the S&P under the 27-20-50, then I think you've got more real problems that a correction might be happening. Otherwise, we might meander here for more time, which is meandering is what we've been doing and we continue to do. So I think watching those numbers might be interesting for guys who are looking for something to hang their hat on. The VIX blowing out 15-16 on the upside, and anything blowing out 20-70, 20-50 on the downside might give us something of significance rather than this meandering stuff that we've been going through.
I like the fact that you brought up China. We've been doing really well for about the past year or so in China, but it hasn't been like the stocks in longer-term established uptrends. It's been in these second-tier China stocks that have been beaten up really bad. So it's kind of like where pigs fly there too. And the old adage for those people who might not be a little new to the markets is that a bear market. Let me just get this right. A bull market ends when pigs begin to fly. When you see all these lower level penny stocks and cheap stocks and begin to fly, but I don't care as long as they're moving it. And we've been doing really well for about a year or so in those China stocks. So the clock may be ticking, but I'm just going to follow along and not try to outsmart it.
And similar to our stock market, maybe the larger names in China are rolling over while the second tier are making a move, which is similar to the Russell and the NASDAQ making new highs while the Dow and the S&P are lagging a bit.
Yeah, ideally I'd like to see them all sync up and go the same way. All right, cool. Again, I'm Dave Landry, DaveLandry.com. I do have, I think I mentioned at the beginning of the show, if you go to my website, click on free reports, I've got a half a dozen reports there. The one you want to start with is a 21-page report on my philosophy on the markets, a short term to intermediate term, and hopefully much longer when it comes to markets. A little bit of psychology. Got a psychology article in there. I'd encourage you to read that too, and a couple of setup type of articles too. So if you click on that, you'll have a pretty good taste of the methodology. Maybe you'll have 95% of it. The other 5% is just some details. So to wrap the show up, David, I'll let you re-mention our guests, but I want to thank you guys for being here. This was I know I say this often, but I think this was one of our better shows. So, but I don't want to brag too much because people in the other shows might be upset. But this was a really enjoyable show. So thank you guys for showing up. I appreciate you guys coming back. David Kosmeter, thank you once more, and thanks for Timing Research. So to you, David.
All right, thanks, guys. Just want to remind everyone who's watching that you can go to TimingResearch.com/reports and download the most recent or any past reports there from Timing Research. And also later in the week or next weekend before Sunday afternoon, be sure to go to TimingResearch.com/current survey to fill out the next survey there before the next Sunday's report is released. So just want to thank my guests, Ed Carlson of SeattleTechnicalAdvisors.com, Roy Swanson of SteadyTrader.com, Jim Kenney of OptionProfessor.com, and of course Dave Landry of DaveLandry.com. Thanks for hosting again.
Okay.
Thank you very much, David.
Thanks, everyone.
Yep.
Thank you.
Thanks, guys.
Take it easy.